Hey, good morning, everybody. Missed you guys for the last couple of days. I'm glad you joined us today. I do want to thank you for joining us today. And the other thing I want to mention real quick before we get started with Dave is, hey, if you appreciate this and like what we're doing, please share it out there with your friends and family out there on Facebook. Be a great thing. So as we get started again, I want to remind you before Dave gets on, the other thing is our free report on retirement planning strategies, how important it is. We hit new highs last week. And so definitely this is important that we have a strategy in place. All you have to do to get your free copy of this report is text the word retirement to 863-285-3815. That's 863-285-3815. Hey, Dave will be with us just a moment. Stand by.
Light FM. There we are. That's Culture Club there. Hey, good morning. It's 8:38. That's 22 before 9. Time to check in on your money. Find out what's happening to Wall Street today and what's happening to your money today and what they're doing to your money today. Phillip Statler is back. He's in his offices at Statler Financial Services in downtown Sebring. Phillip, good to have you back. How you doing?
Hey, I'm doing well today. Missed you guys. I know missed Friday and Monday. Friday was no fun. I had to meet a repair guy at the house. That's never fun. Yesterday, though, I enjoyed a little downtime over in Vero Beach. Had a family thing on Sunday and just spent the extra night over there. So I had a great day and great weekend. And so glad to be back, though, back here in the saddle and looking at where we are from a financial standpoint today.
I got you. We're glad to have you back, too. Yesterday was kind of a yawner of a day, everything being relative. We actually gained a little bit on the Dow, off a little on the NASDAQ, off a little on the S&P, pretty much like the day before in terms of trading. I kind of surmised yesterday morning from the way things were looking that a whole lot of things are on hold to see what actually does happen at the G20 this weekend. President Trump and President Xi of China have been talking about they're definitely going to meet. They're definitely going to talk, and they're definitely going to get something done. I got to believe that every hedge fund investor is monitoring their Twitter account lately to see if there's any possibility of that status changing, right?
Dave, that's just way too many definites in there to think that something's actually going to happen.
Yeah, that was kind of hitting me at the same time. And because of that, Wall Street is kind of saying, we're not going to really make any really big changes. One thing that might make the change, Chairman Powell is going to be doing a rubber chicken speech in New York today. This will be the first one from a major player in the Federal Reserve since they made their decision and the strong hint that they were going to reduce interest rates in July. That's something I got to assume a lot of people are going to have their ears tuned on to.
I got to think so, given that interest rates continue to slide. They're back up from a little bit from the ultimate low that we saw the last couple of weeks. But still, hovering at 2% or so is still significantly reduced from what we saw in the last 6 to 8 months. And so I got to think, though, that may be good for the real estate market as mortgage rates have to start falling, given that those interest rates are falling even on the 30-year treasury.
Absolutely. The 10-year bond dipped to under 2% again in overnight trading. I know it recovered a little bit, and we're over 2 again right now. But this junk matters not only to an indicator of where the equities markets are going, because they kind of go in opposite directions, but for our friends that have some money in CDs, if you ever want to see interest get above 1.5%, you're cheering for at least a little increase in improvement in interest rates.
Yeah, if you're sitting with money thinking you're going to make something in CDs, or if you think you're going to keep from losing money, folks, I got to tell you, if you have money in CDs today, you are losing money by the time you pay taxes on that money, and by the time you figure out purchasing power and inflation, you are losing money every day that we have money sitting in CDs. There are other alternatives out there that would be better served, that would better serve you. That's for sure.
Absolutely. Even if you've got them in a tax-deferred account where the income tax isn't an indication, it used to be the small guy's flight to safety, but now the interest rates on CD level accounts is falling 25, 30% below the rate of inflation. So yeah, you're losing money every day that you're in one of those instruments.
Yeah, they are, and people are feel like they're safe, and believe me, you're not going to see your dollar value decline, but when we look at the rate of inflation, even as low it is right now, and given what interest rates are, you're still losing purchasing power, and given how long we're going to live in this day and age, you can't afford that.
True. And the doggone things aren't as liquid as a old-fashioned passbook savings account, so you're not even keeping liquid assets available by comparison. It just ain't there. But and the future doesn't look very bright for them, given how low the interest rates are on the federal bonds, right?
Well, yeah, exactly. Given what the treasurers are trading at now, I believe you're correct. There's just not much hope out there right now.
I expect you're right. The news item that's affecting things a little bit this morning was that President Trump yesterday announced that he's slapping a whole bunch more sanctions on Iran. I didn't know there was too much more we could get mad at them about and shoot more stuff in their direction, but evidently we are. And the overnight futures pretty much took a tumble. But that having been said, really, we're in pretty good shape. We're still holding a couple of hundred points below an all-time record on the Dow. Just a matter of like 6 points below an all-time record on the Standard & Poor's. And NASDAQ isn't a long way away from their all-time. For all the upset in the world, the equity indexes really aren't doing that badly, are they?
No, they're not. And what's really unique right now is we see interest rates diving to lows, and yet we still see the market. I mean, it's a little red today, but we're seeing markets go up and hit and bump against all-time highs, and so that's got to be confusing to folks.
I've whined about this for years, that all the old standard rules of thumb just don't seem to be working in today's economy. There's the old rule, like I've voiced before, generally when interest rates start dropping on yields on bonds, that means it's a flight to equity and the stock market's about to tank. Well, we're getting both ways. We're seeing declining interest rates and rising stock market rates. Nothing's working the way it used to, right?
No, it doesn't, and that means you've got to put some new tools into place if you think you're going to survive retirement, especially, Dave. If you think about it, if you're 5 to 10 years out from retirement, or you are already retired, and you're still doing the same thing you were doing when you were working, that's just a recipe for disaster.
It's just the old rules, and percentages of equities versus bonds. Those old rules of thumb. Yeah, they still have an application, but really, and for true, having somebody with their finger on what's going on currently, looking at your holdings, is a heck of a lot more important right now, and a heck of a lot more useful right now than all those old rules of thumb, because absolutely none of the ones that my old finance teachers taught me seem to be holding as being absolutely true anymore at all.
Well, that's so true. Yeah, that's so true where we are today. And I think that, people are think they are diversified because they have a bunch of mutual funds or a bunch of this. And what I'm finding when I look there, they're really not. They're not as diversified as they feel they are. And so there's more risk in their portfolio than what they have any idea. And so that's really what we're seeing. And man, I tell you, this market bumping up against these highs are, we've talked before, we need to have exit strategies, and I hope folks have it out there.
Absolutely. One of the things that I made mention of yesterday that gives you an indication of some disconcerting anyway is the fact that the earnings per share figures for the indexes are all well within the range. As a matter of fact, way below the top end of the range. There is room for growth in the stock market, but the fact of the matter is we haven't been going on a skyrocketing binge on the equities, primarily because there is this upset down the line. That gives me the indication that we are cruising for that inevitable recession that's eventually going to happen. We are not buying up to the kind of price earnings ratio that one would expect given an economy that's in a relatively healthy condition. Once again, an indication that things are hinky at the very least.
Yeah, and weren't you telling me before we went on air, you've actually seen somebody that you kind of follow that thinks we're already in a recession?
Yeah, one of the market watch economists was saying, yeah, we're already in a recession. He's looking at the flattening out of the leading indicators and saying that we're already in a recession. I kind of goes through my mind, first of all, wait, are you just trying to be first and then everybody's going to forget you when it didn't happen? But, he might actually be calling a soft landing recession, which would be perfectly fine if we just had a slow drift downward for a few months and then started back up again. That's kind of everybody's hope, because we all know a recession is going to happen.
Exactly. We've talked about the economy, expansion and contraction, and ultimately, we're at the late stages of expansion. Actually, we are getting close to that contraction phase, and we know the business cycle is the business cycle. You may be able to postpone it, but you can't change it totally.
That's absolutely true. We're marking time a little bit because both of us are watching our tickers for a housing report coming out of the federal government. I haven't seen it on mine yet this morning, and I bet you haven't yet either, right?
No, I haven't. But I do have a couple companies to report as we kind of close out this morning, Dave. I've got Lennar Homes talking about new homes. They came in $1.30 a share for the second quarter. They beat the consensus estimate, which was $1.14. Revenue also came in a little bit above forecast, though they've seen a little bit of a dip in new orders from a year ago, and deliveries were up about 5% this last quarter, and they're trading up about 3.5, a little over 3.5% this morning, and they're getting really close to their 52-week high also.
I was going to say there had to be something good there because they're right toward the top of my big winners lists.
And the other one I have is FactSet. Now, FactSet doesn't mean much to any of the people out there, but they are a financial information provider. So we get information. I mean, a lot of our analyst expectations come from FactSet. And they came out and beat by 25 cents a share. Revenue was above the forecast, and they gave full year earnings above the current consensus. So they're also implementing a stock repurchase program. They're up a little bit. They're up about a little over 0.5% this morning.
Cool. When we say the market expected, that's generally a FactSet number that we're quoting since they're kind of the dominant firm in that business, right?
That's right. Absolutely. They're the ones that publish all that information and do those surveys.
All right. Kind of a mediocre day yesterday on Wall Street. Like I said, pink tinge to two of the indexes, a very pale green tinge to the other one. 45 minutes before we open, Phillip, have we got a trend this morning?
I'm not going to call it a trend yet, Dave. Everything is pink. The Dow's down $15. The S&P's down $3.60. NASDAQ's down 13. We have gold ticking up about 0.75%. It's sitting at $1,428.80 right now. I do want to mention we're seeing the highest gold rates right now since about 2013. So it's been a little while since we've seen gold up over $1,400 an ounce. Silver still over 15. It's at $15.36 an ounce. And crude oil, I can see it at the gas pumps today. They're at $57.89 a barrel.
Yep, and at the very least, it's stable from yesterday when I saw the big price bump go up from the weekend action. Overseas markets profoundly unimpressed almost to a single one of them by the saber rattling over sanctions with Iran. Everything's down in Asia. Everything's down in Europe. Not a major sell-off, but it's definitely a red tinge this morning. 45 minutes before we open, again, we're looking at a little bit of pink tinge on the indexes. And Phillip, somebody wants some advice as far as how to stabilize themselves. All those factors we're talking about and the rules of thumb going out the window. I need an appointment with somebody who knows what's going on today. How do I find you?
Then give us a call for our financial x-ray analysis appointment. They can call 382-0037 to schedule that appointment to really determine where they are in terms of a risk analysis. They can get a free report that we have coming out. Retirement strategies, 5 things that you need to be looking at and strategies to consider as you head into retirement. To get your free report, just text the word retirement to 863-285-3815. A great report there. Hey, catch us every weekend for the Statler Financial Radio Show, noon on Saturdays, 10 a.m. Sunday mornings on News Talk 730 a.m.
Oh, I'm sorry. I was rearranging something.
You went to sleep.
Well, no, actually, I was moving a commercial around.
Okay.
And remember, we stream News Talk 730 a.m. at newstalk730am.com. Phillip, thank you so much. We'll catch you on tomorrow, all right?
All right, bye. Thanks.
Thank you, my friend. It's 105.7.
Hey, guys, I want to thank you for joining me again. If you like what we're doing here, please share us and let us know that you're getting something out of what we're doing here. And the best way to do that is share us with your friends and family. Remember, we've got the free report, retirement strategies. Text the word retirement to 863-285-3815. Have a great day, And I look forward to speaking to you again tomorrow.